Hello everybody and welcome back to another video on financial analysis. And in this video we are going to be looking at a company called Microsaic Systems. Now Microsaic Systems, if you haven't heard of them, they are responsible for well, they're a high technology company which develops point of need mass spectrometers designed to improve the efficiency of chemical and biological workflows. Now, not sure exactly what that means, but I'm sure people in the industry do. So their core products include things like the compact MID series of mass detectors designed to integrate seamlessly with a wide variety of third-party OEM equipment providers, or to be standalone at the forefront of our design ethos to deliver fast, easy to use, powerful mass spectrometry performance. Okay, so that's kind of what they do. Not absolutely any much the wiser for me. I'm not kind of, in that area. So this is very much a financial analysis. And this financial analysis is at the request of one of our viewers. So here is Parker45 wanted to know what I think of Microsaic Systems. So this is your analysis. So before we dive in, a couple of things just to remember. First of all, this is a backward-looking analysis. We are looking at the financial statements, and the financial statements tell me what happened in the past. They do not tell me what's going to happen in the future. So if you think you know what this company's up to and what they're going to be doing in the future, the contracts they're signing, the opportunities, the market, the new products or services they're bringing to the market, then please do feel free to share it in the comments. So this is just the financial analysis. So this is part, if you are a potential investor, this should be part of your research, but not the whole of your research. So you might want to look at the finances, and then you look at the business and the management, etc., and the history of the company. Second of all, I hope you find these videos useful. Do please like, share, and subscribe. Obviously, if you subscribe, then you get instant notification of when the next one is available. And do share with your friends and your colleagues if you think anyone find it useful. So don't forget, this is not just for investors. This is for people who want to improve their understanding of reading and interpreting financial information. And so without any further ado, let's jump in and have a look at the financial statements of Microsaic. So here are the Microsaic annual report and accounts, and we are going to whiz through the pages that tell you all about what the company's been up to and their strategy for the future, who's in charge, the board, the corporate governance, etc., etc., etc. And we are going to go through to the actual numbers, the financial statements. Here we are, and they are on page 39. Now, what do we see? First of all, top line, revenue, very, very big drop in revenue. So we are looking from 2019 to 2020. These are the accounts for the year ended 2020. In the left-hand column, sales has dropped from £872,000. The columns are in pounds, not thousands of pounds or million pounds. 872 to just under 200,000. So that's a drop of about 77% year on year, which is very, very significant. The margin is not quite as is actually improved. It was the gross margin was at about 40%. It's now at 50%. But I mean, the company's only making, it's not even making £100,000 in gross profit. And then look at this, the costs of running the business, 1.8 million. And then on top of that, they've got significant research and development. Last year, £1 million. This year, £750,000 of research and development. And they've got some professional fees for corporate transactions going on in there too. That may be fundraising, etc., etc. We'll have a look at that a little bit later on. Anyway, what are we seeing? Well, they are making a loss. They are operating at a loss, £2.5 million. A little bit better than the previous year, £3 million, but still this is a sizable loss. And the bottom line loss before tax, 2.5 million, is pretty significant. So we'll just scroll down a little bit further and see the actual bottom line. And the bottom line for this company is a loss of £2.4 million, better than the previous year of £2.7 million. But if you're making sales of 200,000, then you've got to have a cost base that is commensurate with those sales. They have reduced their cost base, but they haven't reduced it. They haven't reduced it sufficiently, and they are still booking big losses. So very, very big losses going on for this company. Let's go and have a look at the balance sheet then and see what is going on in the balance sheet. So here we see the non-current assets. So the non-current assets are the things we need to run the business. There they are. A little bit of property, plant and equipment, but these guys, you know, they're not a capital intensive business. They don't have a lot of equipment. What they do have is a lot of inventory. Now that is a lot of inventory. If you are, you know, even 386 is a lot of inventory, but 386 on turnover of 872,000 suggests that they're selling. It's taking them about, you know, half a year to sell their inventory, but 570,000 on turnover of 200,000 means that they're sitting on inventory for, you know, 2 or 3 years. So I'm not sure exactly why they're sitting on the inventory for so long, but this suggests they've got some really slow moving stock. Maybe they're struggling to sell it. We see here the trade receivables has dropped. We kind of expect that. If your sales drop, you'd expect the receivables to drop. They got some corporation tax receivable. This is just a tax refund. And they got some cash, and you'll notice a big drop in cash. So it looks to me like they've spent the year effectively funding themselves out of their existing cash. And so you can see with 400,000 in the bank, we'll look at the cash flow in a minute, but it looks like, you know, if you're losing money at the rate of £2.5 million a year and you've only got 400,000 in the bank, then ding-a-ling-a-ling could be alarm bells for this company. Are they going to survive? Scrolling down a little bit further, we'll look at the liabilities. Interesting enough, the liabilities is, you know, the current liability is very, very small. So traditionally, we'd look at the current assets and we compare it to the current liabilities down here, and we see the liquidity ratio or the current ratio. Now, these guys, their liquidity ratio is absolutely fine. So, you know, they're easily able to pay their liabilities. The problem is more about, you know, the future liabilities that they haven't actually yet incurred. You know, are they going to have the cash, or are they actually going to be able to generate? Are they going to be able to turn the corner and actually start making a profit? So very small in terms of current liabilities, very small in terms of long-term liabilities, a little bit of lease liabilities and some provisions. And so the equity, 1.2.5 million pounds on total assets of 1.6 million pounds. So it's really very much an equity funded business, this company. In terms of the movement in equity, there's not a lot to kind of look at going on here. It's interesting. They've got this share-based payment reserve, which is an interesting concept. It's not a massive amount. It's only £324,000. So not sure exactly what that is. That looks to me like that's kind of, you know, shares that they're using to pay suppliers, for example, and to pay options. So they're kind of rewarding staff or perhaps suppliers with shares or share options. And here we see the retained losses. So these guys, you know, they have been sitting on, you know, they've really been funded by the shareholders investing in this business, and they have lost so far, well, a total of £25 million. So if we go back to the equity here, for example, we can see very clearly that the company is funded through the investment by the shareholders, and the company has effectively lost all of that investment. So it's been spent, and maybe they have, you know, now getting close to the point where they're actually going to deliver on that. So quite a lot of alarm bells here. Let's look at the cash flow, see how the cash flow is looking. And the cash flow, so there's the loss up the top. We make the adjustments and we end up with the cash used in operating activities is negative £2 million. Again, it's better than the previous year, which was £2.5 million, but still you're burning at £2 million. And as we said, they've got 400,000 in the bank. If you're burning at £2 million a year, you've only got 400,000 in, you're not going to make it another 12 months. That's the problem. And you know, not a lot of investment going on. It's not a capital investment, capital intensive business, and they haven't really got the cash to invest. And they're just repaying some of their leases. So these are the kind of the big liabilities, are the leases on some of that property, plant and equipment they've got, which is why they've got a finance cost, small finance cost in the income statement. So really, this is a cash business. It's a cash burning business. They don't require a lot of investment, and you know, it looks like to me like they're going to run out of cash. Now, what's interesting about this is if we go and look at the the auditor's report, we would expect the auditors to kind of flag this up. So, we've looked on these, some of these videos, we've looked at, a variety of different companies, and when they think, when we can see that they are running out of cash, there is usually a statement from the auditors who says, we just draw your attention to the note in the accounts. Now, what we see here is that there's no such note. So the auditors say, we've concluded that directors' use of the going concern basis is appropriate, and their evaluation of the directors' assessment of the company's ability to continue to adopt the going concern basis included and they said that, as far as they're concerned, they're happy. So that's quite an interesting one. That's a cleaner audit report than I would have expected. And then if we go to the actual, the notes to the accounts, typically if the directors aren't going to make a statement about going concern, they would make it in the notes to the accounts. And here they talk about, accounting policies, basis of preparation, revenue recognition, etc., etc., etc. There's nothing that talks about this going concern. So they don't actually say that, we have considered this company, in terms of going concern. So I think that's quite an interesting one. And when I saw that, I thought, you know what, we kind of need to look at the latest set of accounts here. So what I thought we should do is look at the interim accounts. So let's just see if we can pull those up. Here's the interim accounts. So these have recently been published for the 6 months ended 30th of June. Now, usually we wouldn't look at these. We're really just looking at the annual report and accounts. But I'm thinking, how did they get to the 30th of June if they only had 400,000 in the bank and they are burning cash at £2 million a year? Either they secure a really big contract and the world has completely changed and they're firing on all systems, or, well, you've probably guessed it as well as I have, they've gone to the market and they've raised additional capital. So let's go and have a look at the finances. So here we see their revenue. So things haven't really changed in their revenue 6 months. They're making, so we're comparing. So there's the year ended 31st of December. There's the numbers that we were looking at earlier. So that's the loss for the year. This is the loss for the first 6 months of last year. This is the loss for the first 6 months of this year. So they're still making losses, and they're up now at £2 million. Good to see the revenue is coming back. So they've turned something around from the first 6 months of last year. So there's the 198, if you remember, for the total of 2020. First 6 months of 2020, first 6 months of 2021. So something's happening. It'd be interesting to know whether we think that the trajectory, and you'll also notice that the costs have come down. So these guys, they are on the case. They are trying to reduce their cost base, but still £2 million profit, is a lot, and they're still having to invest in this R&D. So if they are turning, it's an oil tanker, it's turning very slowly. And if we look at the balance sheet, the big difference in the balance sheet we can see is in terms of cash. They suddenly have lots and lots of cash. And where did that cash come from? Well, it came from the issuing of shares. So the non-current liabilities haven't really changed. And so what we see here is the difference between the share premium, in effect, the difference between what it was and what it is. And that has driven this 4 million of cash. So if we look at the cash flow statement, we can see that fundraising going on. So again, we'll come back to that. So here's the cash flow statement, and very easily we can see that these guys, they're burning well, it's £2 million of cash a year, which is basically £1 million every 6 months. So there we go. There's the £1 million in the first 6 months of last year, the £2 million for the whole of last year, and it's about £1 million, just under £1 million for the first 6 months of this year. Little bit of investing going on, but there are the proceeds from the issue of shares. So £5.5 million. it's expensive. It's expensive stuff issuing, taking out shares. So these are all kind of the broker fees and the bank who's helped them actually kind of, so £416,000 to raise £5.5 million. So if you're buying into this company, you, effectively, a substantial proportion of your purchase has gone to the fees of the bank that helped them raise the money. And then the rest has effectively gone and parked itself in the bank. They've now got £4 million. They're burning at £2 million a year. So you can do the math and work out that they've got another 2.5 years before they'll be coming back to you cap in hand, asking for some more money, unless, of course, they've managed to turn it around. And I haven't seen the investor presentation of their strategy of why they think they're going to break even in the next 2.5 months, and why they're going to kind of conquer the world, etc., etc. This will become a unicorn, because at the moment it's not looking too good from a financial perspective. But as I said, if you know differently, then please do leave your comments in the leave your thoughts in the comments box. Quite interesting here that we've got the kind of the share issue cost. Now I couldn't quite work out what was going on here, and again, if somebody has a sort of some bright ideas, then please do drop them in the notes, because it wasn't clear to me. But they've got, so the shares issued, so there are the shares issued, which is basically 5.6 million, and there are the costs, 4 million. But the costs, what they've done is that they've booked 2 million of costs against the share premium account, and then a kind of a positive 2 million against this kind of the share payments account. So I couldn't quite work out exactly what this actually relates to: share-based payments, share options. And it looks to me like, is that possibly, and I don't know, is it possibly that they are offering share options to the bank that's helping them raise the money? I don't know, but I couldn't quite work it out. So if anybody can shed some light on it and help me out, I'd be very, very grateful, because it looks a little bit funny to me. Anyway, so there we go. So Microsaic, so let's go and have a look at their performance and see how their share has been performing over the past few years. And so looking at their share price, well, what can I say? I mean, this kind of, maybe reflects, a company which, came to market, had a great product, a great idea, and then suddenly it just couldn't deliver. So from 2015 onwards, the shares have been on a pretty much a slide. So if you've been investing in 2013, 14, 15, you'd be sitting on a very, very, very hefty loss. There they are, languishing on, I mean, they're practically free. Now, what's interesting is, don't get sidetracked by the share price and go, oh, wow, they're really, really cheap, I can pick them up. Okay, remember that actually what you're really focusing on is this one. This is the market capitalization. So this is all of the shares in issue multiplied by their price gives you the value of the company, and the company is £12 million. Now, this is a £12 million company. This is the valuation of a company which is losing £2 million a year in profit. It's losing £2 million a year in cash. It's got, right now, it's got £4 million in the bank, but that will only survive, allow it to survive for another 2.5 years at the current rate. The balance sheet is only £1.4 million. Well, it was £1.4 million in terms of the end of 2020. The balance sheet will be, significantly bigger than that. It's probably about £5 million. So it's still, this market cap is still a significant premium to the actual underlying price. And if you compare it to sales, it's 6 times sales. If they're going to make 2 million of sales, in fact, I think they're on for making about 1 million of sales. That's 12 times sales. It looks, to me, it looks pretty expensive. I guess the question is, how long can they keep coming back to the market and raising more money and still telling the story before the investors become weary of it and decide that they're not going to carry on backing it? Again, if you know the answer to that, then leave me a note in the comments box. But otherwise, I'm afraid this company is not for me, so I certainly won't be investing. And there we go. So that is our analysis. I hope you found that useful. Once again, don't forget to like, share, subscribe to the channel. And obviously, you can always leave a recommendation of a company you'd like me to look at. And sometimes it takes me a little bit long to get round to it, but I will try, I promise. So thank you very much. And I look forward to seeing you on the next video.